Alright everyone, Cowboy Trades here, welcome back to the channel. So it's looking like this is going to be a big week for the markets, from FOMC meetings to breaking news crashing the banking sector, liquidity draining from the bond market, volatility inching up, and options traders hedging for a big move to the downside. There's quite a lot to talk about, so let's make this stock market exclusive video, and a little bit later on we will cover what is going on for Bitcoin. So what happened over the weekend? UBS, with a hefty backstop from Swiss authorities, agreed to purchase Credit Suisse for just a fraction of its market value in a package orchestrated by Swiss regulators. The bank UBS will pay $3.23 billion for Credit Suisse and assume up to $5.4 billion in their losses. Now, Credit Suisse did not enjoy this news. Pre-market, it was trading round about negative 55 to 60%. As of the time of recording, it has now consolidated, pushed up a tiny bit, but since its previous close over on Friday, it is now trading down 52.4%. So things are not looking good for the banking sector today. UBS broke down into the pre-market and bounced back up slightly today, but still, most of these banks are not looking healthy. A lot of these have halted trading as of the 9th of March, and the ones that are open, some of these have bounced back, but the majority of these are still in the bin, dumping, and some of them have even broken down and made new lows. I believe when I was looking through these earlier, it was Wells Fargo today has broken down and continued this break to the downside since this most recent drop to the downside for bank stocks. So not looking good for the markets right now. I do believe this is soon going to find its way back into our volatility metrics, as volatility does take another big move to the upside. But before we talk about that, let's talk about these systematic outflows that have caused the yield for the government bonds to take a massive plunge. If we come over to the daily time frame, you can really see since the 8th or 9th of March, the return on bond yields went from a whopping 5% all the way down to where they're currently residing. We're looking at the 2-year at 3.9% today after some consolidation, and it's not looking too good. So what's really happened with the government bonds? Well, the bond market predominantly broke to the downside due to systematic outflows and also a short covering, which you can see if we do come over to the 2-year treasury note futures. If we do look at the book depth and look at the liquidity for this market, you can see liquidity literally vanished for the book depth. Now, if you want to learn a little bit more about how this tool works, then be sure to come over to my channel and check out this video, volume versus liquidity. This is part of my educational series. If you didn't know, you might be looking at this and thinking, hey Cowboy, how are you saying that a short covering took place when the price broke to the downside? Normally short coverings take place when price goes to the upside, right? Well, you may not know this, but the bond yield is actually inversely correlated to the price of the bond itself. So if we're looking at the mid price, the average price of the 2-year government bonds, you can see the average price of 2-year government bonds actually took a huge run to the upside to 103.5. If we zoom down here, look at the bottom right of my screen, you can see when did this, start to bottom out before the rally to the upside in the price for the 2-year treasury notes. It was on the 8th to 9th of March. Let's come back over to the treasury notes. What happened on the exact top? Well, on the weekly time frame, it won't give us the exact date. So on the daily, you can see right here, the 8th or 9th of March is when the yield for the government bonds went down to the downside. So this is why I say it is a short covering. This was a short covering that took place over in the 2-year treasury notes price. Now, as liquidity literally vanished from these markets, it's no wonder that we've had an absolutely systematic outflow. One of the most brutal short coverings we've seen for the 2-year treasury notes in a very long time. Now, what you will notice about this is, once again, like I said, the price of the 2-year treasury notes is going to be inversely correlated to the bond yield itself. So let's look at previous times when there was absolutely an illiquid market trading in the 2-year treasury notes. Over here, you can see there was an illiquid market. This marked the top before the price broke back down to the downside, which once again means that the yield would have went up. If we look over here, there was an illiquid market scenario. The price, it wasn't exactly like a local top or anything, but we did proceed to melt down from there. You can also see a relatively illiquid market roundabout here. This marked a top before a rollover to the downside. You can also see a spike here which marked the top, a spike just before this which marked a rollover to the downside. And right now, bear in mind we're looking at year to date. Before I recorded this video, I looked back even further, and this is one of the largest drops in liquidity we've seen for the 2-year treasury notes in absolutely ages. So once again, systematic outflows, short coverings for the 2-year treasury bonds. I do believe once liquidity returns back to the book depth, that we will start to see potentially some long coverings. We will move all the way back up. What's interesting about this chart is you can see we formed a bullish flag. What happened after then? We broke down to the downside. As you can see, swing high to swing low Fibonacci, came up to the 1.236 Fibonacci. Then when we look at the swing low to swing high, where did we break down to? 1.236 Fibonacci. If we pull up the EMA ribbons, I haven't looked at these so far, but we are coming down to a healthy area of support. To be honest, we really haven't come down to the EMA ribbons for the 2-year government bonds since we broke out of them on the 4th of November when the yield was at 0.26%. So I think as long as we start holding these EMA ribbons, I think as long as we start bouncing into this week, once liquidity turns back into the bond market books, I think we're going to be good for that next move to the upside. Once liquidity returns to the books, and once we have this FOMC meeting out of the way, which by the way is less than 2 days away, over on Wednesday, we're going to find out what is happening with the FOMC. We're going to find out what's happening with the interest rates. I'm personally calling for a 25 basis point increase. Some people are calling for 50 basis points. Some people are calling for a halt and a non-increase in the interest rates. Some people are even calling for rate cuts. I think everything other than a 25 basis point increase doesn't make too much sense. The second most likely alternative is a 50 basis point increase. I mean, judging by how over on the weekly time frames the S&P 500 has been rallying counterproductive against the Fed, up 20% up to its highs, I think this signals to the strength that, hey, if the markets could survive us increasing the interest rates this far and the markets can still rally 20%, then obviously, more pain can come. We can continue raising the interest rates. This is really how the Fed looks at this market. Fed has also been telling us that they've been keeping their eyes on the job market. We made a video on new job data in the labor market. This came in hotter than expected. This is not good for inflation. We also know the Fed has been saying the main thing that they keep their eyes on is core CPI, and on a year-over-year basis for the past 3 months, it's been coming down a tiny bit. It was at 5.7%, the next month 5.6%, the next month 5.5%. What is it going to take, a couple of years or so until we finally get down to their 2% target? You do the maths. I don't think they're going to, be halting interest rates at this moment in time. I think they're going to continue raising their interest rates. A lot of people also use the argument, hey, if the Fed keep on raising their interest rates, then they're going to break the banking sector. Well, my argument to that and common sense would show you that the Fed has recently just created a new fund in which they're going to be providing liquidity, predominantly using the primary window, but mainly these are just going to be loans that the Fed has added to their balance sheet. A lot of people talking about quantitative easing. We talked about that yesterday. Has the money printer returned? Be sure to check that out. But really, absolutely nothing has changed in these markets. The Fed has even created a fund to provide liquidity for banks. So I do believe that means, hey, we might as well keep on raising the interest rates and give these banks excess liquidity if we need to. If they were going to start cutting the interest rates, then why would they create a fund to provide liquidity for the banks? It just doesn't make sense. They don't need to do both. They kind of just need to do one or the other. If they're going to start cutting the interest rates and providing cheap liquidity via lower interest rates, then why do they need these funds for liquidity that they're providing the banks? So really, common sense kind of shows me that we're still going to be getting these interest rate hikes and nothing has changed from the Fed's perspective. So, all in all, everything we've looked at. Also, I haven't covered this, just very quickly. When I looked at this earlier, there was much more volume coming in the options market. There is currently more volume coming in for puts over than calls. It's not a tremendous difference, 260,000 contracts over 216,000 contracts. If you don't know the options market too well, then puts are really kind of just insurance for a move back down to the downside to, hedge yourself in case there is any more downside risk. You can see a lot of volume came into the market today. A lot more was coming into the market this morning when I was looking at this. So I'm kind of a little bit late to the party on this one. I do apologize. I've been a bit busy. But what hasn't changed is the put to call open interest ratio. There is currently, not in terms of the active put to call volume, which is at 1.2%, meaning there's 20% more interest in hedging yourself for a move to the downside. The put to call open interest ratio is at 2.38%, meaning that there's about 2.4 times the amount of interest in hedging yourself for a move to the downside rather than hedging yourself for a move to the upside, which does make sense in my opinion. The S&P 500 is quite overextended. On the daily time frame, we are forming a bear flag, but nonetheless, this doesn't have to break down today. The price target of this would be around about 4,627, which from where we are right now is about another 8% move to the downside. Now, Normally what happens is ahead of these FOMC meetings, we do pump into them. So I do want to make you aware that we don't have to start breaking down as soon as I record this video. We don't have to break down tomorrow. We don't even have to break down straight away over on Wednesday. It is possible, in my opinion, the stock market could push up maybe another 2%. I'm personally not trading this. I'm kind of just watching how this plays out. Could we retest this 786 Fibonacci, come up to the top of this bear flag? We do get that 25 basis point increase, or even, we get a 50 basis point. Not what I'm predicting, but if we do get something like this, then I do think that we will very, very quickly start coming down to these price targets. So all in all, we're getting squeezed underneath resistance. If I clear up this Fibonacci just very quickly, you can still see, all of these macro bear market trends for the S&P 500 are in play. What really caused a lot of volatility coming into these markets is this misconception that the Fed has returned with quantitative easing. And as we discussed, looking at yesterday's video, by definition, it is not true. So for today, my friends, that's all I've got. If you do enjoy these videos, let me know down below by leaving a like and a comment. Share the videos with your friends. If you want to further support the channel, make sure to click the join button and become a member today. Follow me over on Twitter at 618_cowboy. But I'll leave it here for today. It's been your boy Cowboy Trades. I'll see you in the next one. Peace.